Good morning. Today we will discuss the topic of valuation of inventories. Firstly, we see the meaning of valuation of inventories. The final account mainly consists of profit and loss account and balance sheet. Profit and loss account ascertain the profitability of the organization, while balance sheet state the position of the assets and liabilities of the particular date. While preparing these two statements, we will have to take into consideration the value of stock of the goods in hand at the close of the accounting period, the correctness of the profit and loss account, and true and fair view of the financial position as exhibited in the balance sheet largely depends upon the correctness of the value of stock at the end of the accounting period. If stock is not properly valued, the above two statements will give the misleading. Hence, it will be essential to the study in the details of the principles of valuation of stock. As per Accounting Standard 2, which is issued by ICI, is applicable means valuation of inventories the standard is applicable from the 1st April 1999, and it defines inventory as asset. It held for sale in the ordinary course of the business, and it is held in the process of the production for such a sale. It is held in the form of material or supplies to be consumed in the production of the process or the rendering of the services. Accounting standard number 2 further the state the inventories cover the goods purchased and held for the resale. Example, goods purchased by the retailer and held for the sale, computer software held for resale, land or other property held for a resale. It covered finish the goods, products or work in progress being the produced by the concern. Inventory covers also materials, maintenance, supplies, consumables, and loose tools awaiting use the production process. Accounting standard number 2 does not apply to machinery spares which can be used only in the connection with the items of the fixed assets and whose use in the expected to be irregular. Such machinery spares are rounded for into accordance with the accounting standard number 10. It does not apply to work in progress arising under the construction contract, which should be valued at the para number 6 in the accounting standard number 7. It does not apply to work in progress in case of the service provider, that is, incomplete assignment of the consultant, merchant, bankers, hospitals, and etc. Accounting standard number 2 does not apply the investment held as a stock in trade, that's called share debentures held by the finance company, and the standard also not apply inventories of livestock, agriculture, or forest produce, mineral oils, ores and gases, etc. Then we see here valuation of the stock in trade. Valuation of the stock in trade is quite possible that the businessman may not be successful in the selling all those goods which are bought or produced in a period. Some portion of the goods may remain unsold at the end of the year. Such unsold good, which is called as closing stock, should be properly valued and taken into account for the ascertaining the actual profit or loss. Unless closing stock is properly valued and brought into account, trading result will not be disclosed the true profit or loss. If the closing stock is valued at the higher than the cost price, the profit arrived at will at the higher or the loss will be lower than it is and will be mislead the businessman and others. On other hand, if stock is valued at the lower than the cost price, the profit or loss as a disclosed by the trading and profit and loss account would be less than the real profit, or the disclosed loss would be higher than the real loss. This may affect the market price of the shares in the case of companies. Stock in trade is current asset which is meant for the resale on the consumption of the production. The accepted principles as to the value of stock is either cost price or net realizable value, whichever is lower. It is a sound accounting principles that anticipated profit should not be taken into account because such anticipated profit may not be realized. But anticipated losses must be taken into account and provision should be made accordingly to cover the anticipated losses. If stock is valued at more than the cost, its amount is included of the profit elements in the stock. Stock would never the valued higher price than the cost price if rise the price is of the permanent nature. Profit should be taken into account only when the goods are sold. Even the market price is more than the cost price at the end of the period, that's called on the date of the balance sheet, profit and loss account should not be credited with the value of stock at that price as these goods have not been sold out. On other hands, if there is a decline in the market price of the stock, that is in the responsible value, a loss must be already been incurred on the stock in hand. Therefore, such loss must be brought into account by the valuing such stock as realizable value, that is at market price. Another principle to be noted the valuation of stock is that the methods used should be consistent from the year to year. There should be no change in the method of valuation of stock. If the method of valuation of stock is changed, it affects the final accounts, giving a completely false picture of the earning and the financial position of the business. Further, the opening stock and closing stock valuation would be different basis, causing the result to be unrealizable and misleading. Here we see the objectives of the stock valuation are important. There are the five objects of the valuation of stock. First is ascertainment of the correct profit or loss made during the accounting year. Second is disclosure of the true and fair financial position of the business. Third is preparation of the correct statement of the claim for the loss of stock, if any, due to fire, flood, etc. Number 4. Determination of the value of stock on the consignment. And last objective is determine of the value of stock sold on sale or return basis. Here we see the effect of an error in valuing inventory. Error in valuation of the inventory means inventory is either overstated or understated. It has got the effect on the both the profit and loss account and balance sheet. The first effect is if the closing inventories understand the gross profit as well as net profit will be understated. Next is the current asset of the business will be understand. And third is if the opening inventories understated the net profit, the period will be overstated. Then we see here the inventory system. There are two system of inventory. First is the periodic system. Under this system, value of stock is decided by the physically counting the stock at the end of the accounting year. In large size enterprises, because of large volume of the business, stock taking may be take even 1 week. In such a case, purchase and sales are suspended for the about 1 week purchase and recorded at the cost and sales are recorded at selling price. Hence, stock has to be ascertained by the actual stock taking. There are two steps involved in this method. First is count the items physically. Certain item can be weighted in kilograms or tons or in liters. And second, the item counted are listed, priced and added so as to get the value of inventory. For this purpose, a stock sheet is prepared. It includes the particulars of inventory, number of units, price per unit, and value of the inventories. There are some advantages of the periodic system. First advantages is the stock valuation is done accurately, and second advantages means periodic system is less expensive. Then we see the disadvantages of the periodic system. First disadvantages is affect normal business operations at the end of the accounting period. Second, it becomes more expensive if the income statements are required more frequently. Descriptions will never come to light, and inventory control is not possible under this system. Under this system, cost of goods sold is calculated on the basis of stock at the beginning of the period. In the calculation of cost of goods sold, firstly we take stock at the beginning of the period, then we add purchases during the year, then we receive the cost of goods available for sale, then we less stock at the end of the period, and lastly remaining amount is cost of goods sold. It is received to us. This system working in the fourth part. First is previous year closing stock become to the opening stock of the current year. The value of the opening stock is debited to trading account. Secondly, purchases for the period are debited to trading account. Stock at the end of the period is credited to taken account, and the resulting figures is the cost of goods sold. Then we see here the second system of inventory, perpetual inventory system. It is a system of record maintained by the controlling department which reflect the physical movements of the stock and their current balance. It required the continuous record keeping of all flows means inflows and outflows of the inventory items. The inventory account is updated after the each purchase or sale transaction. There are some advantages of the perpetual inventory system. First advantages is the normal working is not disturbed. Second is no to take stock by the physical count. Third, it is clear easier to the control losses. There is no sudden out of stock situation leading to customer dissatisfaction. And last advantage is it facilitates continuous stock taking. There are some disadvantages also in this system. First is it is a costly system. Inventory includes lost goods, and it becomes complicated to record each and every transaction. The stock is valued at cost price or market price, whichever is lower. It is essential to take care to exclude the obsolete or unsellable stock or to provide against the losses. Then we see here the difference between periodic system and perpetual inventory system. Periodic system is based on the physical verification, and perpetual system work on the base on the book records. Periodic system provide the information about the stock and cost of the sale periodically. Perpetual system provide the information about the stock and cost of the sales continuously. Periodic system decide stock and cost of goods sold as the residual figures. Perpetual system decide the stock and cost of goods sold as the balancing figures. Periodic system is a simple and less costly method, but perpetual system is a costly method. Periodic system does not facilitate the inventory control, but perpetual system is facilitate inventory control. And last difference, periodic system is a required suspension of the business activities for the counting of stock, and perpetual system does not affect the operation of the business activities. Here we see the methods of valuation of stock. We see the first method of the valuation of stock is first in first out method. It is also called as FIFO method. Uh, in this method, the items of the stocks are used in the same order as they are arriving in the store. The stock is valued at the rate purchase, starting with the last and working backward. This is done on the assumption that the latest purchase are still on the hand and have not been sold. That's called the goods are sold on the order in which they are purchased. Then we see the merits of the FIFO methods. This method is simple method of the valuation of stock. If price of material do not vary frequently, the stock calculated as per this method, it is close to the present value of the stock because the stock is valued at the most recent price and it is quite logical. FIFO method is most suitable for the valuation of any stock, particularly perishable goods. In practice, this has become the most popular method. No unrealizable profit enter in the financial result in FIFO method. First in first out method is a very useful method, particularly when the prices are the falling, and this method is suitable when materials are slow moving. Then we see here demerits of the FIFO methods. Calculations become the complicated when price fluctuates. In case of the declining prices, the valuation of stock at cost would be higher. The value of stock may not be recent one if purchases are made long back, and FIFO method should not be adopted during the period of rising prices. Different cost may be assigned to the inventories used the production of the identical jobs. FIFO method is successfully used when the size and cost of raw material is very large and materials are easily identified as belonging to the particular purchase lot. It is not more than two or three different receipts are the material card at one time. Price of material do not fluctuate very often so that the clerical work is minimized, and where material are subject to deterioration and the obsolescence, their FIFO method is applicable. Then we see here second important methods of the valuation of stock, which called as weighted average method. Under the weighted average method, the stock is valued at the average of the price at which goods are purchased at the different times. Weighted average price is calculated by the dividing the total cost of the unit in the stock by the number of units in the stock. We use the formula of weighted average price, which is known as weighted average price is equal to total cost of material on hand divided by total units on hand. This method is more effective than the simple average method and it is suitable where the prices fluctuate the frequently for the costing purpose. But for the stock valuation for financial account, the method is not suitable when prices are declining. This method is middle course between the FIFO and LIFO method. The cost to be assigned to stock is decided by the applying average cost to stock. Average cost is calculated by the dividing the total cost by the number of units. Under this method, weighted average cost of inventory is calculated by the formula of weighted average cost per unit, which is used in the preparation of the valuation of cost. Weighted average cost per unit is equal to opening stock plus purchases in rupees divided by opening stock plus purchases in units. And then value of closing stock is calculated by the formula of value of closing stock is equal to units in closing stock into weighted average cost per unit. Then we see here the merits of the weighted average cost. This method is accepted by the accounting standard number 2. There is a reduction in the fluctuation of the purchase of cost each lot. Valuation of the closing stock is done after the considering cost and quantity from each lot of the purchases. Then next merit is new issue prices need not be calculated each time issues are made unless new lot of the materials is received. Then we see here the demerits of the weighted average price. Weighted average system is required the tedious calculations. Material cost does not represent actual cost price in this system. When prices fluctuate considerably, this method will be incorrect result. Identity of the material in store disappear, hence it becomes difficult to verify the stock. Value of closing stock sometime may appear to the absurd due to the changes in price. This system is applicable when materials are received in the uniform lot quantities and when it is difficult to identify each issue of the material, and it is applicable when the purchase price fluctuates considerably. Then we see here the store ledger account. It is maintained by the costing department. It is usually maintained in the loose leaf or card type, and each account represents an items of the material. It is maintained in order to ensure correct store accounting. It shows the quantity and value of materials. There are three main parts in this store ledger. First is a receipt, second is issues, and third is balances. GR number here is calculated, then recorded the quantity, rate, and value of the each column. In the front side of the store ledger account, we record here name of material, code number, location, bin number, maximum stock level, minimum stock level, and reorder book. We use this formula for the practical problem of the valuation of stock. We see first here store ledger account is important for the two methods. First is FIFO method, means first in first out method, and second method is weighted average method. This formula is used for the both methods. Today we see the valuation of inventories in practical problem solution. Firstly, we see the meaning of valuation of stock, then valuation of stock in trade, then see the objectives of the stock valuation, which is called as importance. Then we see the effect on the error in the valuing inventory. Then we see the inventory systems. There are two inventory system: periodic system and perpetual inventory system. We see here the meaning of the periodic system. Merits and demerits means advantages and disadvantages. Then we see the perpetual inventory system, advantages and disadvantages. Then we see the distinction between the periodic and perpetual inventory system. And then lastly, we see the methods of the valuation of stock. In this method, first in first out method, and second method is weighted average method. And in this last slide, we see the store ledger account, means formula of the store ledger account, and some contents in this store ledger account. Thank you.